Distinguished panelists, ladies and gentlemen, good morning. Thank you for joining us on Sunday morning for the third public panel of the Next Gen ESG Investing Program. I would like to thank our sponsors, Erisec Partners, Star Magnolia Capital, Archipelago Capital Partners, and Vertex Ventures for graciously supporting our program. The Next Gen ESG Investing Program aims to identify, empower, and inspire the next generation of sustainable investors. All classes are delivered by leading industry professionals and is designed to support preparation for the CFA Institute certificate in ESG investing. We also provide real capital for our members to put their learnings into practice, generate the investment track record. If you are interested to learn more, you may check out our website at www.genzgroup.org. So without further ado, we shall start the panel. Is quantitative finance a good match for ESG? Please note that this panel is for information purposes only. It does not constitute investment advice. Audience, please feel free to submit your questions via the Q&A function at any time during the panel discussion, and we will address them wherever we can. I will now pass the mic to our moderator today, Mr. Xiao, to start the panel discussion.
Thanks, Tiffany. I can see a lot of the participants are also the students at the Gen Z ESG Academy. I also know you guys just went through a 2-hour quantitative session with Habib. You show up here again. It's quite a lot of dedication. Thank you for your participation. Also, thanks so many other people outside of the Academy attending this session as well. So my name is Xiao. As Tiffany said, I'm one of the volunteers here. And my day job, I'm the Deputy Chief Risk Officer of Amundi US. Amundi is the largest asset manager in France. Obviously, we have a rich history in ESG. And also, I'm also a volunteer at the CFA Institute ESG Committee, working on disclosure standards, verification standards related to ESG. So the topic today is quantitative finance and ESG. Is that a good match? I think hopefully by the end, we deliberately designed the topic in a question format that with the hope that you all can answer this question by the time we finish this panel discussion. We have a very distinguished panelist, and we have obviously the Chief Investment Officer of V Square. I always got to mix it with a V square or V squared. I think a few of you may want to have a view on what that means, and maybe you can join the debate with Habib. Habib Moudachirou is obviously, you know, he got his long tenured ESG track record running HSBC and JP Morgan, et cetera, and then he probably didn't usually need no more introduction. If you Google Habib M, usually that his name pops up. This to tell a lot about, you know, he's being captured by the Google algorithm. Maybe that's about it, the artificial intelligence. So maybe that's something we will cover later about the data processing part. We also have a Professor Qifei, currently teaching in Singapore and US. Obviously, it needs no introduction given the Singapore audience. And yeah, so I think this is probably quite an academic panel. And in terms of what the topic, it probably a very good qualified panelists to discuss this particular topic. Now, I just kind of glossed over, but I think these two have maybe a CV 10 pages long, each of them. So I will probably let each of them introduce themselves before we start with the questions. So I think we should start with Professor Qifei. Please go ahead.
Hi. So good morning, everyone. Happy to be here. Very happy to have the invitation from Alan and Tiffany and be on the panel together with Habib. My name is Qifei. I'm an assistant professor of banking finance at Nanyang Technological University. So my research interest mainly is in institutional investors, and a big part of it is about ESG investing. In fact, I've written 2 papers about ESG investing, one on equity investing, the other on fixed income. And I think we're going to touch upon this topic later in this discussion. One major finding in my paper is about investment horizon and ESG. So maybe a quick take on that note is that maybe ESG is not a good match for all investors, but certain type of investors. We can talk more about that. And generally, I think ESG investing is a exciting and very timely, relevant topic that all students and practitioners should at least know about and perhaps be excited about, because that's the direction to go for many of the financial industry aspects. So I'm happy to talk more about it in a moment.
Thanks, Qifei. We know certainly ESG is a very exciting topic. That's what keeps me and Habib up at night. Usually, it's 10 o'clock my time, 10 p.m. Boston. Habib is 9 p.m. Chicago. After 2 hours of lecturing, he still looks fresh. So certainly. So Habib, I think most of the people here know who you are already, but we do have a few external participants. So please introduce yourself, please.
Yeah, no, absolutely. So I look fresh. I mean, I shaved this morning, you see, it's coming. So my name is Habib Moudachirou. I'm the CIO and co-founder of V-Square Quantitative Management. V-Square, not V squared. It was very intentional because we were thinking about the mathematic formula for V-Square, V squared, but we opted to have V-Square because a lot of the theme we think about, they always come in square, and I can talk to you a bit more about that. So my career, I've been doing this for 20 years, portfolio management, quantitative portfolio management. I came accidentally to finance as an engineer. So that's how I got into quant, applying physics and chemistry formulas to mathematics models, and to also to finance, to try to predict where the stocks would go. And I got to ESG, although it's very fashionable now. Actually, I launched my first climate fund. It was an active climate fund back in 2007. Well, of course, if I had to do it today, I would do it differently because I learned so much throughout the process. But yes, so this is how long I go back with ESG. I managed close to 20 billion over my career. I've done that with HSBC, JP Morgan, and a few other companies over the last 20 years. And 2020, we decided to launch with my business partner. We decided to launch V-Square because we really wanted to specialize, and we believed that we could do something that was great. Although we had success in other companies, those large companies, you know how it is. I mean, maybe you don't know because you're a student, but you're gonna see. We learned, we had great apprenticeship, and we just decided to do it better on our own. And the last thing I can tell you is that yes, I just gave a lecture. I also play the adjunct professor on my leisure time. I was at NYU for 8 years, and now I'm involved in University of Chicago. So research is very important for me. It's not just practicing, especially on the ESG field. There's no modern, I would say, MPT, model portfolio theory type of framework for ESG. There is one for finance, but there's none for ESG, and this is the type of thing we're trying to frame.
Thank you, Habib. Thank you, Qifei. I think it's a good introduction for the audience to know who you are. Maybe let's start with Qifei. I think a lot of people are interested in your academic research. I think, in fact, we already got a question about can they have access to your paper. I mean, so reading your professor paper on Sunday, I think only Singapore has students like that. So anyway, so floor is yours. I think I'm very intrigued about your research about equity and fixed income, and sort of one of the conclusions is time horizon play a very significant factor in terms of suitability of ESG strategy. So could you walk us through the overall academic approach and a high level, and in particularly, is any distinction between equity versus fixed income, and as well as how big of the factor the time horizon is, and is there any other factors? So, well, anything you can tell us. I think we're very curious, very intrigued about your research work.
Yeah, sure. So I'm glad that there's interest from the audience on my research piece. So if we turn back in time before 2019, because I know in the past 2 years, 2020, 2021, sustainable investment vehicles, or mutual funds that target ESG stocks, have had a brilliant performance in the pandemic period. But if we turn back in time, I think before 2019, it wasn't very clear from historical performance that if, as an investor, you pick stocks based on their ESG profile, or if you tilt your portfolio in a way that's ESG friendly, that will definitely help your performance at least in the short term, right? So that gives asset managers a sort of a trade-off to make. If they're particularly concerned about whether the investor will be willing to keep investing with them, or if they will redeem their shares on the first sign of trouble, if your fund underperform for 1 month or 3 months, they will redeem the money, then perhaps investing in ESG stock is not a very promising proposition for the fund managers, for the asset managers, because they are first and foremost, their goal is to maximize the amount of assets they manage, because that's how they charge their fees. And if ESG involves heavily investing in sustainable practices in the near future, and that may hurt short quarterly earnings number of the companies, then if you are facing outflow, this is a luxury that you cannot afford at the moment. So the gist of our paper, one of our paper on equity side of ESG investing, is that if you look at all the asset managers and look at their portfolios, see whether they're tilted towards or away from good ESG stocks, there's a very strong correlation between how volatile their flow is. Meaning, this month I get a lot of inflow of money from investors. Next month I perhaps underperform, and the money flows out. If you are that type of mutual fund managers, then you don't tend to tilt your portfolio towards ESG stocks, because you're not sure whether this long-term proposition of ESG, that it will create value in the end for the company, whether you are able to see that through. Perhaps long before that project pays dividend for shareholders, your fund has faced large redeem and you have to sell off your position, and then everything is moot, right? And on the other hand, if your funding structure is relatively stable, that your ultimate asset owner are either patient, that they understand what you're doing, or they have a higher tolerance for short-term volatility, then you're in a better position to invest in good ESG stocks. And if your proposition is true, that those efforts in either cutting carbon emission or improve your environment footprint, those will eventually be appreciated by the market. You are in a good position to coup those benefits, because you are not subject to the volatility of short-term flows, and you are not forced to liquidate your position before those benefits eventually realizes. So that's the key message of the paper. There is a match between ESG and certain type of investor, and our research suggests that it is a long-term investor. Investors, either they have a long-term horizon, or their ultimate capital provider has a long-term horizon and are more patient. Those investors are in a better position to invest in a way that's consistent with ESG.
When it comes to these ESG factors, right? And was there a difference between equity strategy and fixed income strategy, at least within the ESG universe, in terms of what's the emphasis is, any differences, or if there is such difference, does that impact the time horizon conclusion?
Right, there's a very good point. If you think about the payoff structure of equity versus fixed income, of course, in equity, you recoup all the upside of the investment. So if you have a project that's, I don't know, create better gender diversity in your employee force, treat your employee well, right? These type of ESG efforts, we typically think of that they will boost productivity of your employee, and then perhaps they will work harder or be more innovative, and your firm will have will perform better in the future. Versus in a fixed income, if you're buying a debt or buying a bond, the upside is capped, right? From an investor perspective, if the firm performs super well, the best you can get is you get all the coupon payments and your principal back. But if the firm perform poorly, and from an ESG perspective, if there's a oil spill, right? Or if the government tightens its regulation on the pollution or carbon emission, impose a carbon tax, that's a downside for the company. And as a bondholder, you are the one who are left with holding the bag, especially if things really go bad. In the case of, let's say, PG&E, the utility provider in California, their power line triggered a huge forest fire in California, and there's huge legal liability imposed on the company and they have to declare bankrupt. That's where it hurts the most for the fixed income investor. So if you think of equity investors are the ones who enjoy mostly the upside benefit of ESG investment, and fixed income investors as one who don't gain as much from upside, but they really care about how large is the downside from ESG liabilities. That suggests that for fixed income investors, even though both equity and fixed income investors can care about ESG, they may care about different component of ESG. And for fixed income investor, I think what's most important is the downside protection and also the regulatory exposure from ESG. You don't want to be in being an industry that's regulated out of business by this ESG shift. So there's different component of ESG, and later on, I think we'll talk about ESG just encompasses many different factors. But for fixed income and equity investors, they care about different things.
Certainly. Thank you so much, Professor. Yeah, I think sitting in the U.S., our high yield bond index has like roughly 13-14% are in an energy company, and they certainly feel that way that they're in the wrong business nowadays with the ESG shift, and their valuation on the equity side, it really reflects that. Now let's switch gear a little bit to Habib. I know he just had the lecture, but he's so eager to go, I can tell. Anyway, I know this is a quantitative panel. Habib, you had extensive background in Europe and the United States. Whenever people talk about ESG, because there is no universal definition just yet, and now you're talking to an Asian audience, so hopefully that does not add even more confusion to the definitional vacancy vacuum. But anyway, so because there's no definition there, and then seems to be some divergence still in terms of people's understanding. But how do you normally define ESG? Because I know mathematics knows no geographic boundary, right? But because since we're on a topic and it's unavoidable, people have different philosophical view or definitions. Sometimes it's philosophical difference. Sometimes it's basically their self-interest. So I guess question for you is, for the V square, given there's a lack of universal legal definition, how do you guys define ESG as a starting point?
Yeah, I mean, that's the starting point. ESG now is very common in the language and in the mind of people, and it's something that's kind of accelerated in the last few years. But if we go back to, I would say 2003, 2004, 2005, people were talking more about SRI, which is socially responsible investment. And then this evolved to ESG and then impact investing. So this is basically the three differences that I make. So for me, SRI, which is socially responsible investment, is more about negative screening. So people look at their portfolios. So they start with a universal portfolio. Let's say they want to get a world portfolio. So they have their world portfolio. And then they look at companies that are either controversial, or they look at companies that do not align well with either their faith, because you have your Sharia compliant investment portfolios in the Middle East. You have faith-based portfolios here, even the US or in France, Catholic-based. So they will remove companies who have business involvement in either alcohol or who have business involvement in manufacturing weapons, business involvement in alcohol, already said alcohol, or adult movies, all those things, and then remove them from the portfolio, either from the first or second degrees. And so this is what I call what I view as SRI. On the other side, what I view as impact investing is more about positive screening, meaning that you start with a portfolio where you have nothing, and now you try to identify companies who actually their business model is about producing goods or solutions to combat either climate change or to combat poverty or to try to make communities better, the people. So that's the S. So the E or the S. So that this is really what I call impact investing. And we talked about fixed income products, for instance. If you think about fixed income, there's a whole class of new assets within fixed income, sub-assets that I named the green bonds, or you also have the social bonds. So for the green bonds, for instance, those are bonds that are issued by companies or government or agencies, and with the proceeds of the issuance are specifically destined or targeting helping to combat climate change or to invest in the renewable industry. And if you take social bonds, it's kind of the same thing, but on the social side. So it's either to make the community's life better. So that's the impact investing. And now ESG, when people think about ESG, most of the time in portfolio management, it's about ESG integration. So how to put elements of environmental, social, and governance in the way that they are analyzing portfolios. And I was discussing that earlier in the panel. When we think about ESG, we're not thinking about ESG as just one whole thing. It's just a complementary measure. It's just something that you add to make better informed decisions, investment decisions. So this is how we view it. And at V-Square, really the approach that we took is really, there's a lot of data providers all over the world. I was saying there's almost 600 ESG rating that are available. So how do you go about, what rating do you take? And there's a lot of variability, a lot of discrepancies. The same company can be rated AAA by MSCI and rated BB or poorly rated by Sustainalytics or by Robeco. So, and all those data providers, they have their own methodologies. So you have to know it very well. The other problem with on top of the variability is that there's a lot of data that is available all over the place. So how do you integrate everything? And, I always say that me as a portfolio manager, my objective is not to maximize my ESG score. My objective is really to maximize the return. This is the mandate that I have for my investors. And I know and I understand that if I can identify the metrics that actually have financial advocacy, meaning that they are financial relevant. So if you look at climate, there's things that are very intuitive, carbon intensity, or the type of climate risks that companies are experiencing. I think we mentioned the wildfires in California, for instance. If you have all your factories in California, or if you are a bank and you have all your offices in those places where there's a lot of wildfire, you are definitely at risk, and it's going to come directly from your balances. So it's going to affect the pricing or the valuation of your assets. So those are things that we want to be really cognizant of. So what we do is that we really try to identify those metrics that are a stable signal and very consistent signal into how to better manage the risk of the portfolio and also to take advantage of opportunities.
Thanks, Habib. And certainly in my role as the head of risk, I witnessed the ESG started as a sort of almost a risk management concept exclusively. I mean, to some degree, that's still true for a certain strategy, and now to more about opportunity set, defining opportunity, finding the new next frontier, both in terms of the data, the investment universe, adding green bond, changing efficient frontier, or some new technique, and we're going to touch later. Now, I'd like to remind the audience. I know this is an Asian audience. Students usually wait until the end to ask the question. You are allowed and also encouraged to ask questions throughout. In fact, there's some bonus. Whoever asked us the first question, the real question, the substance question, not like where to find the material, that kind of question. Whoever asked the first substance question, you can actually have that direct FaceTime with all three of us. Later after the session, we can answer other questions you may have. But anyway, I would just want to encourage people to ask questions live so we can actually weave that into our presentation. So the thing about ESG is every time we talk about ESG, tomorrow we have the same panel, the three of us, plus Tiffany, we're not going to have the same thing because that's how fast information is being produced. That's why quantitative technique is fairly important, because we are processing an unprecedented amount of big data. So I think speaking of that, I just want to ask maybe some macro question to Qifei, maybe Habib as well. Now, in terms of the, we can probably give away our age. We have been in this, quantitative easing era for more than 10 years. right? So a lot of people use, like, they're talking about a trade-off. ESG, incorporate ESG may have some performance impact, but, and also the capital provider will be hesitant to allocate. But on the flip side, and quantitative easing has produced abundance of capital around. Before the panel's discussion started, Professor, you and I were just talking about in the high yield market, the trend is almost a disappearance of the covenant, because this is heavily skewed towards the issuer, instead of moving towards the investors. So what do you think is the quantitative easing in terms of the abundance of the capital? Do you think, does that help ESG in terms of helping us finance the better future? Or do you think that's not that clear cut? There's a lot of nuance behind it. I think, Professor, you can probably take on that first, and maybe Habib can add on to it later.
Yeah, so that's a good question. That's a tough question, right? Because we're living a quantitative world for the past 10 years, I'll say. So it's almost, and ESG investing has risen dramatically over that 10 years. So in a sense, we do not know what ESG investing would look like in a world without quantitative easing. And that's a difficult question. If you think that in the future, quantitative easing will eventually go away, right? In a sense, we do not have any historical guidance on that. So I think to answer the question whether quantitative easing is good for ESG investing, I think the answer is twofold. I think it's a good thing for ESG investing, but I'm not 100% sure whether it is a good thing for ESG. And there's a distinction there, because I think early on, Habib had a very good point that there are a spectrum of different ESG investing. And I think there are two ends of the spectrum. They're not contradictory because everyone is doing a mixture between the two. On the one end of the spectrum, I think people are asking the question, is quantitative finance a good match for ESG? So here, the means is the quantitative method, the investing method, and the end is ESG. And there you see all the negative screening or impact investing, where I think at least the stated objective is to use financial tools to finance projects that are otherwise difficult to be financed, but yet good for the environment or sustainability or future development, right? And there, perhaps the investment return may not be as attractive as other types of investment, but investors have other objective in mind. They want to facilitate change to a better world, so they go for ESG investing. The other end of the spectrum, I would say, is the question asked, is ESG a good match for quantitative finance or quantitative investing, where ESG is the tool, but a better investment outcome is the objective. And I think that's what Habib talked about for ESG integration, right? And there you can think of ESG, all the emission data and other indicators, ESG ratings, as another form of alternative data, big data, where traditional finance model have overlooked. And if you are the one who can identify ESG factors that improves your model in terms of predicting stock returns, then you can come up with a portfolio that offer a better return, offer a well-managed risk profile, incorporated some of the ESG considerations, but at the end of the day, your clients or your asset owners will be happy because you offer a higher risk-adjusted return. So back to the question of quantitative easing. I think during this phase of abundance capital, ESG investing has flourished. The practice of incorporating ESG in order to achieve better return has performed tremendously, especially in the past 2 years. And I think part of it is because the abundance amount of capital and they flow to industries that are more upcoming, the more tech industry, and then it facilitated the performance of ESG portfolios, either intentionally or unintentionally. My thought is actually a lot of it is unintentional, because you see tech stocks that are overweighted in ESG portfolios, they're boomed, but most of it because we're in pandemic, everything is going virtual, so that's why those stocks outperform, right? On the other hand, I'm not entirely sure whether this quantitative easing have facilitated projects that brings about positive change in the world above and beyond that, it's just rising tide lift all boats. Perhaps this abundance of capital have facilitated all projects, but I'm not sure that ESG or sustainability-oriented projects are benefited particularly well in this in this environment. So I think it's yet to be seen from all pool of investors who proclaim themselves to care about ESG, what is the breakdown of investors or clientele who think ESG as a means to achieve better return, and what are the fraction of clientele who think of ESG as a goal of and by itself, and they are willing to stomach a less stellar return in exchange for bringing about better change to the world.
Thank you so much, Qifei. I think you're spot on that the blind showering of the money by central banks itself does not necessarily push us, the investor behavior, in a particularly responsible fashion. In fact, you can probably see some evidence of contrary in terms of what we call zombie company just refuse to let the creative destruction of the capitalism to play its right hand. I think that's probably why I think Habib's company always have this line, say intentionality matters, right? You have to have the intention to direct the capital. It takes a Herculean human effort to make a difference. Now, I think, I'm so glad the market still respond to incentive. After we promised people we're gonna spend time with them, I got two questions from the students. Unfortunately, the first question was anonymous. Tiffany, we need to find a way to identify the first question. Otherwise, I couldn't tell who the person is. But anyhow, so let's start with that. The second question, I will save a little bit later because I know Habib, we're going to get to that. The first question is a more generic, as what the thoughts about the big corporation, Apple, Amazon, Microsoft. They're currently opposing the U.S. climate bill. And I think the question is there a nuance? Because we're not a corporate spokesperson. I'm sure a corporation will have a million reasons to tell us why there's some imperfection in the bill that hinder their performance or unintended consequence or what have you. But what's your view in terms of, I guess the philosophical question is big corporation, are you doing enough to support the climate bill or advancing the climate agenda, which is a global crisis? I mean, there's no right or wrong answer. I think it's just based on, because you guys are both deeply to the academic research as well as the, actual investment space. So what's your thoughts on that? Habib, you can take on that first.
I can go. I can go. Yeah, it's very interesting questions I'm seeing on the chat. So to answer about the FANG, here it's Apple, Amazon, Microsoft that I named. Yes. That's the thing, when we look at ESG or the data or the metrics, we always talk about materiality. This is what I was talking about earlier. And if you're just looking at, let's say, environmental data for Microsoft or Apple, you're going to find that they have a very low footprint. And then you're going to say, okay, they're great for ESG. I'm going to just put them in my portfolio. But unfortunately, climate data or environmental data are not data that I would call material for those companies, those tech companies. For those tech companies, the data material are more on the S and on the G side. So we look at data privacy practices, we look at data security, the type of breaches, because those are serious things. Because when there's a breach, I think the largest breach in the history of the world, I don't know if you remember Yahoo. Yahoo had a breach that they only reported in 2017, and the breach happened 3 or 4 years ago. 2.5 billion of customers had their identity exposed with passwords and second, backup email and all those things, and they hide it up until this is when they were completing the not the acquisition. They were being acquired by Verizon. And it actually depressed their price, the price that Verizon was paying it. But if Yahoo wasn't still on the market, you would have seen the price of Yahoo just go way down. This is the type of thing you want to invest, because you can be blindsided just looking at data that are not material for those companies, while you have other data that are very important. So yeah, they are not supporting the climate bill. It's also great because even on the environment side, now we start looking at, I'm going to get a bit more technical. Usually people look at scope 1 and scope 3 for the carbon, scope 1 and scope 2 for the carbon emissions. Now we are looking at scope 3. So basically scope 1 and scope 2 is what, the company itself is producing in terms of energy and the type of resources that they are consuming when they're emitting carbon. Scope 3 is how they are impacting indirectly, how they are emitting carbon indirectly via, the type of the suppliers that they have, or even downstream with the customers, or with if you are a bank, you're JP Morgan, HSBC, if you're financing companies that are polluting, now we're going to be factoring this in the way that in the carbon footprint that you are living on the environment. So I mean, the short answer is that, yeah, it's not a great look for those companies to oppose the US climate bill, but they will be penalized, because at the end of the day, what matters is the customers, the stakeholders in more general. It's no more a society where we only look at the shareholder value. We now look at a lot of other things, the stakeholders, at everybody else that are interacting with the companies. So those are the customers, those are the employees, because now you have employees who actually just resign, or they just don't want to work for companies who are not doing the right things, because they have the choice. And, I know I'm talking to Gen Z students, but millennials were actually, they started the whole thing, and millennials are now 42 today. And yeah, if you don't like the way a company is behaving, you don't feel proud of working for that company. So you have the choice, you have options. And this is happening. And because those companies are not going to be able to, if they don't do the right thing, they're going to start losing talent. And they're only going to be stuck with people who cannot be anywhere else. And it's going to ultimately impact them, and also turnover costs and all the things. So this is the S thing. And this is material for companies like that, Apple, Amazon, and Microsoft.
Well, live lecture. So if anybody, so just before you start, Professor, if anybody has a question later about scope 1, 2, 3, this came out of the European Union, so that's why Habib is well versed in that. So I just want to let people know we're more than happy to provide any supplementary information around that. And I think that the goal for that is to not penalize any particular industry, because once you look at scope 3, capture the value chain, actually, kind of a level the playing field quite a bit. Tesla is no longer looking a lot better than ExxonMobil, for example, stuff like that, because if you look at the entire chain. So we just want to make sure people understand that we're ready to give you more information around that. Sorry, go ahead, Professor.
Yeah, so no, Habib had very good points, and just want to chime in to say that there is a risk of losing sight of the forest for the tree, because I know we're talking about ESG investing, we're talking about those carbon emission data of individual companies. And by the way, Microsoft have 0 carbon emission, because every year they go out and buy what called carbon offsets, which is basically donating money to grow trees, which might not have been cut down. That part is a little bit, there's controversy around it. But on reported forms, they have 0 carbon emission. But if you take all the corporate commitment to carbon emission into account, their effort will be tiny relative to what a carbon tax on the level of US federal level would do. If US institute a similar carbon tax as European Union is going to do, that will reduce the carbon emission in a very effective way relative to the individual carbon pledges made by companies. And I think almost all economists agree that carbon tax is the most effective and efficient mechanism in reducing carbon emissions. But I understand that companies have their own political considerations in opposing or supporting bills. But I think, as Habib said, this can be one thing that investors care about for their investment, for the portfolio companies, that they can push companies to move political agendas, much similar to they can elect directors and force companies to declare their own carbon emission goals. I think investors moving forward will have the power to actually change the political stance on companies, especially on legislations that are material and critical for the goal of achieving carbon emission target. And then time is running out on that. So it's not like something we can wait and see if those self-declared carbon targets of individual companies can collectively get us there. It can't. It must come from, at least part of the solution must come from a more political and legislative perspective.
Thank you, Professor. I don't know which one is generating more political excitement. It's Amazon paying zero tax or Microsoft that has zero emission. Maybe both are interesting observations. So let's. I know there's a lot of good questions here. I think Habib, you're fast reader. You probably finished reading all of them already. There's a lot of question about the quantitative approach by V-square. I think the students haven't had enough after the 2-hour session. So anyway, I think you have this very in-depth. We had a very in-depth conversation, you and I, about climate VAR. So perhaps I think that probably going to address some of these questions. Maybe you can quickly walk through climate VAR, also in terms of modeling technique, how you go from looking at the climate data and then translate that into something that can be integrated into the investment process.
Yeah, absolutely. So, I mean, I kind of scanned through the questions. So I'm going to try to address the next 5 questions in just one answer. I'm just going to start with May, who was saying, I think, how do we, when you step out of just carbon emissions or climate, how do you deal with subjective things like governance and social? I'm going to start by saying that it is not subjective. Governance and society, it is not subjective. Of course, you have to take into account the geography where you are. In social, if I'm talking about diversity, I don't mean the same thing for a company that is based and operating in the US as for a company that is based in Japan and operating in Japan. If I'm voting, if I want to push diversity in Japan, I'm going to look more into the gender diversity. If I want to push diversity in the US, I'm going to look in both gender and ethnicity. So there's a lot of things, and it's all about materiality, because at the end of the day, why I'm going to look into this diversity is because I have proof, and there's a lot of studies, research that I looked at, and are also made that show that generally companies that are more diverse, they tend to have better profitability. There's not a direct link, but because when they are more diverse, it helps a lot of other levers that help to the profitability. And this is what you want to take. And there are many ways of doing it. You have some research. You can just take a universe. You take the companies that are diverse, the companies that are not diverse. You go long one and you go short the other one. And you look at the result. Here is your alpha, diversity alpha. But I'm not going to call it that way. But this is really, and it can be complicated across geography, but those are things that are not subjective. They are objective. And there's a lot of governance practices. When you look at the incident reports, those are things that you want to know about companies. I'm not just looking at the rating for social. I just want to know if the company is handling well the incident report, the labor practices, how are they? Because usually those are red flags. If the labor practices, or you have incident reports that are just snowballing, they're just going up and up, that company is going to have a problem at some point, and it's going to make the headlines, and the price is going to be hit. And this is a type of risk management that we are doing. So it's not subjective. Of course, you have some variables that are subjective, but we don't look at those because it's more difficult to prove financial advocacy. And so more generally, how we look at V-square, how we look at quantitative look at ESG, very simply. I was talking about V square versus squared. So basically, we have a square of 4 quadrants with a theme that we have identified as being financially material. The first one is materiality, of course, and for that we use this is our starting base. We use the SASB, which is the Sustainability Accounting Standard Board, which actually, what they did is that they have 77 sectors, 77 sectors, industries, and they made a whole map with against 27 or 28 ESG themes. And for each of those subsectors, they have identified which one is material and which one is not material. So we start with that. And the three others quadrants are climate change, of course, governance, and the last one is human capital and technology, because we believe that humans, at the end of the day, people are the blood of any companies. And, it's very important to look at how the companies, those metrics that we have available for the people, the turnover within the companies, the diversity, and technology. We really wanted to put technology because there's also a transition that's happening, that's a transition to more technology. There's even papers out there who are saying that very soon, a lot of jobs are going to, it started already, but a lot of jobs are just disappearing because now machines can do them. So those are the things that we want to look at to make sure that at least the direction of travel of the company is right, and they're really adapting well to that transition. And we know that if they are not, they're going to hit a wall and they're going to have a problem. So this is how we view it. And then with all those themes, we have the metrics that we get. It's not ratings, it's not scores. Those are, we go one layer down, we get the real metrics, and we basically cook our own meal. And what I mean by that is that we created our own score. We trademark it. It's called the squared score. If you want to know more about all this, you can go on our website, VSQM. So those are the initial of the Square Quantitative Management, vsqm.com, and we discuss all of that. And there's a lot of papers and because this is something that we really do. And just to go back to some comments that Qifei, and thank you, Qifei, you're helping me so much today. Thank you for everything you said. So intentionality, it is so important. And this is really the first pillar of everything we do. In the last 2 years, yes, if you look at ESG strategies versus their peers that are not ESG, but kind of a similar, but not ESG, they are overperforming. But I don't want to get too much excited because it's accidental. And like Qifei said, the virtual, all those companies who are not climate, they don't have a big footprint. Technology companies, they really took advantage of the fact that everyone was going virtual. And of course, oil companies, guess what? Because you're not driving, you could say, I was in New York, so I could see a blue sky. It didn't happen to me for 15 years. And there was no one on the street. So oil, at some point, I think there was one day where they were paying people to put gas in their car. So just to give you an idea. So yes, so all that to say that intentionality matters, and a lot of people, a lot of portfolios today of funds, they are just relabeled ESG, or they just you have some big asset managers. All they do is like they try to repurpose some portfolios, but they keep the same investment process and they still have the same proxy voting policy. And because ESG is not at the core of what they do, it's very hard for them to actually take everything else that they're doing in the company and try to repurpose it for ESG. So it's more like a market gimmick. So we call it greenwashing. And now it gets also to greenwashing, which is, I think Qifei evoked that. Greenwashing is basically you try to pour money into something, thinking that it's just going to be the solution. Yeah, so what we try to do is really to be intentional, and research innovation. Those are the things that we do to try to create a very a framework for what we are doing. Because when you're intentional in creating your portfolio, very purposeful, you try to identify the metrics that you want to put. You create something that makes sense. You just don't you don't look at your portfolio. And this is what happened. I think 2018, 2019, people looked at the portfolio that they had. They were like, they scored them. They were like, oh, my portfolio is ESG, so I'm going to add ESG to the name and try to sell it, because this is where all the quantitative easing money is going to.
Yeah, certainly. Greenwashing and greenwishing. So for those of you interested, there's a very recent case in the United States, DWS. You can Google it in terms of greenwashing, in terms of making claim that the investment manager making claim about ESG are really not substantiated. There's a lot of incentive to do that. And also, I do agree with Habib in terms of a lot of time people will say the values are not universal in a different geographic, different political system, but oftentimes, and then that is usually the difference is usually in how, not what. The United Nations certainly agree with Habib. That's why there's a SDG 17. Anybody can Google that. That's lay out some kind of a universally agreed sustainability goals. So, but yeah, so thank you for that, Habib, with the awesome explanation. I guess we haven't really got to the super quant stuff yet, though. But I think there is a very important question. Conscious of the time, we're having really good discussion. There is a question that obviously we cannot ignore, which is E and S and G. You know, they point. Sometimes they point to very different directions, right? And sometimes they could even require different, I wouldn't say contradictory, different investment actions. So inevitably that calls the question, which one is more important? I guess the answer is always depends, but I wanted the panelists to give some, more elaborate explanation in terms of depends on what, all right? Okay, so maybe Qifei, you can address that first.
Yeah, I'll go first. Yeah, so as Alan said, ESG are all important, but depending on different situation and the context. I would view G as a little bit different from E and S. I will view G, governance, as sort of the infrastructure of the company. Meaning, if you do well on E and S and perhaps generate value for shareholders or larger stakeholders, G will guarantee that that value is not appropriated by insider, the managers, CEOs, right? They do not steal the money and go home, take the money, right? So if you don't have a good G, then no matter how well you do on other aspects of the company, the outside shareholders or outside investors are not guaranteed to get a good fair share of the company value. So I will view G more as a good infrastructure of the company. Although I need to point out one fact or one point about G is that traditionally when we talk about corporate governance, they say in the good governance in the name or for the purpose of shareholders, right? It's all for maximizing shareholder value. But some aspects of discussion about E and S in recent years have led us to think that perhaps corporations need to think both of their shareholders and of other non-shareholding but important stakeholders, like their employees, like their local communities. So in that sense, if you have a very ruthless, optimized governance structure in the traditional sense of benefiting shareholders, it could come in conflict with E and S. Okay, but let's leave it aside as a extreme case. And for E and S, I think they're both important, and because there are many different topics underneath E and S, it's hard to say which one is the most important. But I do think that a certain aspect of E, which includes climate, of course, and then the general environmental protection, these two are at least have the most consensus around it, that everyone agrees that we need to do something about carbon emission to salvage our climate from going to a hellish situation, and everyone more or less agree that we need to protect our environment for a more sustainable future. So because these two factors, these two aspects, climate and environment, have the most consensus built around them, I think they are the most suitable, or at least most ubiquitous in terms of your quantitative investing, because across markets, we've seen that climate issues and environment issues have generated a consciousness, and they have be associated with stock returns. Whereas other issues, especially social issues, do differ from context, from country to country. So that requires much nuanced analysis in different different markets, and also they're time varying, right? So last year, after George Floyd death in the US, there's a huge surge in consciousness about racial justice. So you as an investor, you need to keep up to date with the market context and with the recent event in order to keep up with what particular aspect of the social factors are feeding into stock prices.
Thank you, Qifei. Conscious of time, there are a lot of good questions. And thanks for letting us know Disney was against the climate bill too. They bought Marvel 2 years ago. Hopefully they have some fighting spirit there. about fighting the climate crisis. There was a last question. I was thinking that's a fairly common question, Habib, for you maybe. A lot of time, the ESG integration really stop at the bottom up security level. Like we got the ESG rating, looking at this or that, like MSCI, a lot of the off-the-shelf solution. But it's not clear how the portfolio manager, we're talking about, for those of you very familiar with the setup of the asset management company, portfolio manager assemble the portfolio, research analyst provided security name. So the question really is, well, what is the distinguishable part that the portfolio managers do from ESG integration standpoint beyond this just research analyst incorporating the rating, either internal rating or external rating, into their sort of the intrinsic value assessment of the company? So Habib, could you in the remaining couple of minutes, would you mind addressing that?
Yeah, no, that's a great question, and it's only great questions today. It's good because I can tell we don't use ratings, and in the course right before that I was giving, I was making the analogy between cooked meals and meal that you order from the restaurant. So imagine if you use rating, for me, you're ordering a meal from the restaurant, and it might be good, it might be bad, but you don't know how it was cooked. And you may have an idea, but you don't really have the recipe. If you're cooking your own meal, you can try up until you get the right recipe. And once you have the right recipe, you can cook every night and eat a very good meal. So this is how we view it. So what we do is that, a lot of managers, what they do, they would go to an MSCI or Sustainalytics. They have a data provider they get married to because they're paying them a lot of money. Data is very expensive. And the data provider is giving them the ratings. So they would use the rating to rate all the companies and to try to integrate them in your portfolio. We have a different approach. And this is why we really wanted to have a different voice. And I know at large companies, it was really hard to make it happen. I think for us, the better way of doing it is to go 1 or 2 layers down. So what we do is that we are totally agnostic of data providers. So if we need carbon emissions, they are just the carbon emissions. I can get them from MSCI or I can get them from Sustainalytics, but those are the carbon emissions that were reported by the company. So I would go 1 layer down, I would get carbon emissions, I would get incident report, I would get diversity, I would get anything I need to actually, that I know makes sense within the themes that I have, and then just add them and put them in my squared score, the one I described a little bit earlier. And yeah, so this is really how we go about it. I think the other question was, so that's bottom up. We also do top down. So top down, the best example I can give you is that usually when I want to make a macro allocation to countries, what I used to do when I was not taking into account the climate, I would just look at the country and then take a look at the GDP. Of course, I had model, but just the inputs were the GDP, the inflation, the 10-year rate, and whatnot. Put them in the thing, and then that would give me a better, if I had a world allocation, it would tell me, okay, you should put more in Europe, a bit less in the US, a bit more in Asia, those type of things. But it's great because we have a partnership with the MIT. We've been working with them for almost 2 years now. And they came up with a great tool that nobody really is paying attention to, but it's just a great tool where they actually remodel they actually understood, they model the social economic outcome due to climate change. So basically how much climate change is affecting XYZ region. So you can have it also in your model. And now you have a macro model all of a sudden that is not just looking at economic variables, but also are looking at socioeconomic variables that are impacted directly by the fact that there's a climate crisis. And this is what we use at the macro level, which is from the top down.
Thanks, Habib. So you can tell I purposefully skipped the second to last question, how the manager differentiate themselves. I think the answer is right there, right? So whoever has the better data that go beyond the off-the-shelf solution, and whoever actually used ESG to do risk and allocation from a risk budgeting perspective on an ex-ante basis, that is really the differentiating, because you're right. The issue is right now there aren't that many ESG managers have a really long track record because the industry is evolving. So it's not that easy to compare from an LP perspective, from a GPLP perspective. So yeah, that's why intentionality and then the process matters more at the moment. So with that, I think we addressed the most of the question. I know it's a two minute past. Just one last thing though, you know, in the ESG space, people will have to be super vocal to be successful, at least, you know, just be good at speaking publicly. If one person has the courage to ask a question live, turn the mic on, we can answer that. Anybody want to give a try? Or not? But that's okay. All right. Okay. Cool. With that, I'll turn it back to Tiffany and with some closing remarks. Thank you.
Yeah. So thank you so much, Habib, Qifei, and Alan, for the really insightful panel discussion. I can definitely see how engaged our audiences are just from the quantity and quality of questions asked. So to our participants, we will be hosting another panel on the 10th of October at 11 a.m. on how asset allocators evaluate ESG. So we have invited Cambridge Associates and Bank of Singapore to come and speak to us on how they look into the matter. And it could perhaps address, I think, one of the questions that participants asked about how to differentiate greenwash risk managers from someone who intentionally and truly care about ESG. So do join us. Sign up information will be available on our linking account, Generation Z Investment Club, later today. And that's all. Thank you again for joining us on Sunday morning and evening for Habib and Alan. And we hope to see you all again in our next webinar. Thank you and take care.
Thank you.
Thank
Bye-bye.
you.